Jeff, Neuberger Berman recently published its Solving for 2026. Tell me a few of the key themes that you outlined for the year ahead.
Well, at a headline, we come into this upcoming year quite positive. There's a lot to like about the market. Earnings growing double digits, the economy is strong, and the AI infrastructure investment cycle is driving substantial GDP growth by itself. So we are continuing to lean into equities, and a few themes that we would call out is there will be divergences. There's going to be winners and losers. We also would call out the fact that AI is going to be a double-edged sword. And then finally, we think the worst is over for long-term rates. So we think that treasuries now offer better value in the intermediate to the long part of the curve.
When you say AI could be a double-edged sword, you don't want to land on a sword. So can you tell me the best possible case and the worst possible case?
Yeah, the good news is you can now pick either debt or equity because we know there's tremendous amounts of debt being issued to support the AI infrastructure. That allows you to be more conservative in the capital structure if you are concerned about the risks. But we think that the double-edged sword really is going to be in the implementation. So we are reluctant to say this is an all or nothing bubble. There's going to be these winners and losers, and certain companies may have too much euphoria. They may not have the cash flows or the capital to back it up or the implementation, but it will take years before we can really measure that return on capital.
So if and when the AI market broadens out, who's going to benefit the most from that? Which sectors?
So clearly the hyperscalers have been the beneficiaries thus far, but eventually we do think it's going to translate into pretty much every GIC sector under the sun. And we do think it scales for larger cap companies because they have the IT budgets to be executing. But we do think active management and bottom-up security selection will be important because you're going to have to talk to management teams to see how is this technology changing your cost structure, your efficiency, and is it creating new revenue streams for you in the future?
Okay, and what are the headwinds that you're watching in case things turn against some of your earlier predictions?
Well, I do think that the job market has been decelerating. It's getting a bit choppy, as we saw this morning. And the productivity benefits of AI is also causing sluggish markets that may translate into softer consumer spending. That's one of the main risks that we will watch, along with this debt cycle. So the fact it does feel to us that credit is getting tight, it's in terms of the spreads, and it may be causing undue risks to be taken. And so we're going to watch closely for possible elements in the credit markets.
And what about inflation? That's a worry from a lot of investors.
Yeah, so while we think that there was a delay in the disinflationary trend due to the tariffs, of course, it was not derailed. And coming into 2026, we think core inflation will get to a more comfortable level of about 2.5%, still above the Fed's target, but a more palatable level that will allow central banks to focus more on labor and less on inflation.
And then finally, we're talking about things that come out of Washington. It used to be that people would watch Wall Street for problems. Now people are watching Washington. Is there anything else that you might expect that's going to happen in 2026 that's coming out of Washington that could affect Wall Street?
Well, hopefully Washington will not get too hands-on with the Fed chair, but we know there are some elements around that. But as the midterms grow in importance, if we have a divided Congress, that is going to create some challenges. The good news is the OBBBA has already been passed and legislated, and the stimulus of that will have traction regardless of what happens in politics.
All right. Well, thanks for coming on and talking about it.
Thank you for having me. Appreciate it.